All right, good morning, everyone. Welcome to the Hurley Investments Trade Findings and Adjustments for, we're on Thursday the 16th of March, halfway through our month already. Just to bring some things to speed. Right now, what is the newest market catalyst that we're going to fight? What is it right now? I mean, if you're going to be placing a trade, this is information you should definitely know, right? Or if you're going to be making an investment, what is the newest catalyst that you should pay attention to? Jeff, perfect. I'm going to change just a little bit, but Jeff said bank failures, right? And I'm going to primarily say regional. The big banks don't have the same kind of risk. They've got a little different risk. And these are everything from runs on cash to I'm going to say liquidity for lending / borrowing. So I'm going to do it a little bit different, right? / and this is the fun part, right? Poorly run. We knew years ago we had an inverted yield curve, which means any 60-40, any fixed income was going to be trashed. And we knew 5 years before 2 years ago that bonds have had a run like that's never been seen before in the market, and that it was probably time to cash in the longer term bonds and roll them into these shorter terms for the yield curve, right? Well, Kevin, you didn't mention that. And I've already had someone say, well, Kevin, why didn't you mention that, a year ago? You just ripped on bonds. You didn't explain it like you're explaining it now. And I've had someone accuse me of, well, you just let those poor people fail. And it's like, well, those poor people are my competitors. I'm sorry, but forever, if I've talked about the issues with the 60-40 or the Harry Markowitz splits, it's always a losing proposition. Sorry. 60-40 type of accounts are set up so I make more money on commissions as I churn you out of certain positions in the market. Well, I go with Fisher. Well, just because Fisher doesn't pay their registered investment advisors those commissions, the bank, the firm still gets those 1201B fees, and they're still there. Don't think that it's the person that's not doing it. What's the other catalyst? We've got one more catalyst coming up next Wednesday. What's the second catalyst that's going to move our markets? What's that? Oh, there we go. Wow. 3 of you really jumped on that one. FOMC, Federal Open Market Committee, interest rate hikes. 322. We'll probably start hearing about it tomorrow, maybe Monday. And plain and simple, both of these move markets what direction? Both of these things that are happening right now, what direction do they move markets? down, lower, bearish. Wow. Again, you three are just on fire. Down. So we got Jeff, Jim, Alex. Alex, I haven't seen you or don't know you. Welcome to today. And obviously Dave and David are here. You guys are always here. It looks like Abraham's here. Yeah, so that we're going to say bearish, right? That's the technical term in our industry. It moves them bearish. So if you were putting on a trade today, and today our markets are going higher, I'm pretty sure. Oh, come on, Hurley, you have this already. Makes no help. Sorry, guys, thought I had it all for you. Yeah. So here I'm telling you about all this. The market is up almost a percentage point today. Market obviously is not paying attention to what should happen. If you're to put a trade on today, how are you going to play future market movements? That's a question to you guys. I want you guys to answer that. You guys are now in my position. I'm not managing accounts anymore. What are you guys thinking as you're looking at what you would do for your accounts? Okay, so Dave, let me work on that one here. I am ready to pull the trigger on protection. So remember, we're trying to make sure everything is protected on Friday, because inevitably we're going to have the worry coming into Monday that, hey, Fed could raise 50 basis points. Fed could raise a quarter. Fed might not raise anything because the CPI and the PPI are, were pretty tame. Well, I don't see that. They're still going up, right? The CPI was up 0.5%. The core CPI. In fact, it's really, if I can go ahead, I'm going to take this right here. Let me put this in so you guys can understand it. I find this really interesting. I am shocked that people don't understand inflation. In 2021, I'm going to use a yellow one. Looking at this chart, in 2021, the inflation rose 7.5%. In 2022, the inflation rose 6.4%. Somebody tell me what this means. What does 2021 7.5% inflation and 2022 6.4% inflation mean? Wow. Bingo, Bill Brandner. And I'm going to go ahead, I'm going to say Alex and Dave, all capital letters. This does not mean inflation is coming down. Well, Kevin, 7.5, 6.4, it's lower. So, yes, lower inflation year over year. That is correct. But 7.5% inflation growth plus 6.4% inflation growth is equal to 13.9% inflation growth over 2 years. Our inflation's not coming down and reversing. It's 7.9. At one point, it was 9.0, but it did come down from there. In a 2-year period, everything we bought 2 years ago on average is 13.9% higher. With that said, gas is almost double. Gas is like 80% higher. Chicken eggs, 110, 20% higher. Milk, 50% higher. There's a lot of things I can tell you that are significantly higher that's happening right now because of inflation. Ooh, I love this one. Also, debt is rising and credit cards are being maxed. Credit cards are being maxed with the prime rate, 600, 800% higher. So you're ready to put on protection. I'm just going to say, better do it by tomorrow, because next week the protection will be at a higher premium. You're going to see the price increase, and it's going to increase significantly. Where I think it was Jim Kohler, Jeff Hall, putting on new positions. Better be non-directional or to the downside, most likely, because the risk is to the downside, right? The risk is not missing upward movement. The risk is having the Fed come in and say, we're doing 50 basis point rate hike. Someone was kind enough to say the other day, well, Kevin, I think the market expects a 25 basis point rate hike. Well, the last time we got a 25 point basis rate hike at the end of January, it took away all of our returns for the year. As soon as we got that rate hike, boy, I don't have anything opened up here right now. I should do a better job. Keith's going to say, dude, you've got to be better prepared if you're going to take over trade findings and adjustments. Let me pull it up really quickly so you guys can take a look at what I'm seeing. And it's okay to disagree with me. Please don't think my crystal ball is better than yours. It is not. It's in fact, it's scary. I sometimes have some people look at me and say, well, Kevin, you know, what about this? What about that? Let's face it. My crystal ball is no better than anyone else's. As we're looking at a chart, pretty sure it was the 27th. We probably had our rate hike right here. We ran up a couple more days and down we came to test the 200. A little bounce, banks, down we came to test where we opened the year at. Right there. I mean, let's face it, right now we're up a quarter point or quarter percentage point for the year. So if people are expecting a quarter point interest rate hike, it moved the market for 3 days. And I would dare say we're in worse position today than we were 5-6 weeks ago, right? 200-day is acting as resistance. We can't get above it. We really don't have any catalyst to the upside. $3,600 is probably where we're going to the downside. Let's do some quick assumptions here. Why would the Fed only do a 25? Yeah. Quarter point rate hike, right? Versus 50 point versus none at all. Let's go with the none at all, right? Why would the Fed do none at all? Does anyone here believe that the Fed will not raise interest rate hikes? Okay, so 3 of you just came in. I'm going to go for all 3 of these. None at all, because it will affect companies to fire more people. Okay, so out of curiosity, and I'm not saying I've understood this, isn't that a reason to raise the interest rate hike? Didn't the Fed want to increase the unemployment or the circulation of money? So, Dave, with all due respect, your first reason is actually a reason why they would raise interest rates. This is what they want to have happen. I don't completely understand that way of thinking, to be honest with you. But I don't, with all due respect, I don't see that at all. All right, Jeff Hall, none or 25% because they don't want the banks to implode. So they don't want the banks to implode. Is that their directive? Is that one of their two directives to save banks, Jeff? No. Okay. Let's put this into another perspective. They just raised rates over the last year and a bit, right? They just raised rates 4.5%. And now only 0.25 will make implode. They just raised it 22 times higher the previous year and 3 months. 22 times higher than that 0.25% interest rate hike. But now this one will make them implode? Okay. And Jeff, at any time you can say, Kevin, just piss off. You're bugging me. No, but they want to calm down the markets. Okay, so one more time. Is the stock market the Federal Open Committee's directive? No, it's employment and it's interest rates, right? And interest rates are to control inflation and protect the dollar. So let me go one more time. Let's go up here. One more time. Why are banks imploding? Someone tell me, why are those banks imploding? There's a very, very specific reason. So Jeff, kind of paying out high rates on short-term rates, loaning at less. So that's kind of complicated, and I think that's jumbled. Can someone else help Jeff out? Paying out high rates on short-term rates, loaning at less. Someone help Jeff out. And Jeff, any chance, did you listen to our Monday webinar, our commentary? Jeff, go back to a My Hurley Investment, singular there, myhurleyinvestment.com. It was a really long commentary. We got all it spelled out. It'll probably help you understand more. I went through on why the banks were imploding. Someone help Jeff out. There we go. Love it. Too much using low interest rate bonds. My freaking sake. Can't type worth beans today. So that is the reason. In plain English, poor account management. Meaning they sat on longer term bonds when the yield curve inverted. They didn't sell off longer term bonds and buy shorter term bonds. Jeff, you weren't here last week, last Monday. All that means on 30-year bonds, right? I guess those might be T-bills though, right? Notes, they're notes. I can't remember what they are. On 30-year bonds, paying 0.25%, lost the on paper par value. They always come in at $1,000, right? But why would you want a bond for the next 30 years that pays 0.25% when you can buy that same bond marked March of 2023 and get 5.5%? So that $1,000 on paper that they paid for that bond, in 30 years, they're going to get it back. If they bought it 2 years ago, in 30 years, Jeff, they're going to buy it back. They're going to get their $1,000 back. But the problem is that they're getting like 22 times more interest. So that bond that only pays 0.25%, they paid $1,000 for it. The today value of this bond is $120. Banks borrow against these like cash assets, these treasuries, right? Well, what they thought they had $1,000 to borrow against, they only have $120. And if you have a run on the bank and people want their cash, what was worth $1,000 a year and a half, 2 years ago, you can only sell for $120 today. So you're selling your investments at an 88% loss to satisfy your customers making a run on the banks. Will another 0.25 point help that? No. But another 0.25 point, another 50 basis points is irrelevant. They blew it because they're investing and their money managers got paid a big amount of money to put them into these bonds, and then they stopped working. They weren't paying attention to what was happening. It's affecting all the banks. Now, it started out with the crypto bank over in New York. It moved to the venture capitalist banks in Southern California, where these, VCs, self-fulfilling prophecy, these VCs told these tech startups, hey, you got to pull your money out. The VCs imploded Silicon Valley Bank. They did it to themselves, which is going to piss off the VCs because some of these startups were living paycheck to paycheck. Well, they're still going to get their money out. Well, it'll be a messy process. The money isn't there. 25 billion doesn't cover 600 billion in liabilities. It's a messed up process. So here we go. I'm taking way too long, but if you wanted to place a trade or new position, we would be looking to a bearish moving market. What we're looking for probably goes on tomorrow. SPY at the money puts and smaller accounts. And we're probably going to go out for 414 or 421 expiration. And it's ideally to protect for next week, Wednesday. The rate hike. And the talk will probably start tomorrow or definitely Monday. And you'll see fear build up. We might even do this trade the end of today. It might be the end of business today. Let's put it on. We'll sit through a down day tomorrow with these puts in protection for next Monday, Tuesday, Wednesday. I sometimes get this question. How much do you lose on protection? So let me ask you guys, how often do you lose on homeowners insurance? How often do you lose? All the freaking time. Okay. How often do you lose on car insurance? Jeff, I like that, and I'm going to bring it out. And same thing with you, Dave. I like it. Yeah. We lose every single time we don't use it, right? We lose every time we don't use it. Let's put a big button there. But does it give us peace of mind? Does it get used eventually? Does it save the portfolio when the bottom goes out? And we probably all have those answered, right? No, it's not like health insurance or car insurance or homeowners insurance, because you know what? The protection gets used more often than not. Kevin, do you keep track of every put and how much it makes? No, I don't. I look at the portfolio growth. I look at what we had to go through and if it was worth it. Sometimes the protection is not a nominal dollar figure return. Sometimes it's I don't know what the hell the market is doing. But I know I'd rather have 94, 95, 96% of my total invested capital protected than letting it ride. You know what the difference is between gambling in the stock market and gambling in the casino? It's hedging your risk. Protection hedges your risk so you never lose 50, 60, or 70% in any given year. And that's what it's for. Any questions that you guys have that I can answer for you today? Any questions you guys have that I can answer for you today? So I love Jeff's. Jeff's is, no, great job, well put, good explanation. And then we have in here Dave. So how much is the Fed going to raise interest rates? The Fed will probably raise a quarter point. They can't stop. They should have raised at 50 basis points in January, and they blew it. They missed it. They were probably going to raise 50 basis points in March. And I think they're going to say, hey, the market is too unstable for 50 basis points. But they won't say market, they'll say the economy. The economy is too unstable for 50 basis points. So my expectation is they'll probably raise it a quarter percent, 25 basis points. Reasons why: they can't stop inflation still going up. Core CPI was 0.5 versus 0.4. Regular CPI was matched at 0.4 at 0.4, but core is the big one. Well, Kevin, PPI came down. Yeah, but it's CPI that matters most. It's the PCE prices that matter most. I really think they're kicking themselves for not raising it 50 basis points in January. They now will probably feel like they're boxed in a corner and they can't raise it 50 basis points this month. So my expectation, 25 basis points in March, 25 basis points in May, 25 basis points in June, 25 basis points in July. August, they'll stop. Or September. I might not have the dates. Let's find out the dates really quickly that we have. FOMC rate hike meeting schedule. So this is pretty interesting. May, June, July, and then it's September. So what was going to happen is they're going to raise January, March, May, and June. And then in June, the expectation was that they're going to say, hey, we're going to take a pause for half a year. We're going to let our rate hikes run through the system. We should have had a nice run through the second half of 2023. That has now changed. Because we still have spiking inflation, we probably have interest rate hikes March, May, June, July, adding one extra month, one extra quarter point, which means it'll be September 19th and 20th, right? That they will come out and they'll do the, hey, we're going to stop now, which pushes our 6-7 month growth in the back of 2023 now to really October, November, December. We might have a really sweet Christmas rally run, but now the timing has shifted farther out. So unfortunately, 25 basis point in March, 25 basis point in May, June, and July. And then they can't say if they raise the rates in July, they're going to stop and wait. They'll have to come out most likely in September and say, hey, 0 or our last 25 point rate hike, and then we'll stop. So we lost from June 13th, 14th to the rest of the end of the year. That was supposed to be our growth. It was supposed to be our comeback. We're supposed to take off. That's what's happened this year, why the rates have changed and why we're in a different time frame now. Dave, does that answer your question? Any other questions you guys have? Now, so the neat thing is, if you had listened to Keeve last Thursday, for those that put on SPY puts, your SPY puts are probably doing pretty darn good. If you had listened to Keeve last Thursday, he's like, you know, a good trade, some SPY puts. We've had a bunch of days where it's gone down and down pretty good. I'm sure those SPY puts are profitable. In fact, you're profitable on those 25, 30%. That would have been a unique trade to be in already. All right, guys. Hey, I see no other questions coming in. Have a good rest of the week. We look forward to visiting you on Monday. Jeff, my www.myhurleyinvestment.com It's singular there. We really spent a lot of time last Monday going over the collar trade, how it works, how that sometimes extends the time frame. And we went over, obviously, banking and what was happening so you guys could better understand. You can pick that up. You can listen to it at your convenience when you're ready. All right, guys. Hey, have a wonderful weekend. Enjoy yourselves. Look forward to seeing you on Monday night. I do hope this was helpful. This is how we try to always include some type of education as we're going through a trade. But normally, we'd love to have this just be a quick 20, 25 minutes, down and dirty, hear the trades. Obviously, as things are changing, we do the same thing. And yes, I have seen Baidu. So if you noticed, Baidu is down almost $7. And right now, if I take a look at Baidu, Baidu is up $4. Pretty interesting. What you saw is you probably saw a sell of block orders. So a fund sold out at Baidu down at 132, and it's now heading back higher. So they sold out, they bought back in. That quick deep drop, and then you start to see it recover, is just a fund selling shares out and buying back in at a new cost basis. All right, guys, have a wonderful weekend. I will see you on Monday. Take care, and until then, hedge your risk. Talk to you later. Bye-bye.